Hey, very good afternoon to you. In today's episode of Growing Your Tree of Prosperity, we will be doing a shallow dive into this manufacturing company called Valuetronics, all right, with a ticker symbol BN2. Now, Valuetronics is an electronics manufacturing service provider, EMS, and the design, manufacture, and supply consumer and industrial electronic products for global brands. Okay, and what is the difference between industrial electronics versus consumer devices? Okay, for industrial electronics that Valuetronics deal with, the components need to be more durable, they must function in harsh environments, and the sensors and the controllers are going to be a little bit more pricey compared to consumer electronics, and they must have strong EMI and over voltage protection and must endure extreme temperatures. So it's very interesting for me, given that I completed my degree in electrical engineering 20 years ago, to learn the difference between an industrial electronic and a consumer device. Obviously, that's not in the engineering syllabus. And I hope that is future generations of engineers would learn a little bit more about business before they graduate. Okay, so some products include from Valuetronics lighting systems and automotive electronics, which have longer life cycles and higher margins. And this ICE segment, which is industrial and commercial electronics segment, is 80% of its revenues. All right, 80% is revenues, which is quite substantial. So at least you understand what drives your profits. But as a manufacturing firm, Valuetronics, they value cost efficiency. So you need to have the usual quality management systems and all that just to optimize your costs. Okay, but it's winning new customers in the electronic vehicles, the Internet of Things, and the medical equipment space. All right, so there's very little growth, but there is growth. Okay, market capitalization is fairly humble. We're talking about $298 million. Okay, definitely not as large, not as large as I guess Centurion, right? The real estate companies with billions of dollars worth of real estate. Okay, the gross margin is 17%, which is sort of mid. Okay, for manufacturing firm. PE is about 10, which is fairly good, fairly cheap. But what I love is that the price to book ratio is low at 0.21, which makes this a very deep value play. Admission, I have been a long-term shareholder of this company for many, many years. I've been holding on to it for over a decade. The fact of the matter is that it's been paying dividends regularly for many years, and I've not really been tracking it, right? I have a portfolio of 60 plus stocks. A lot of these stocks are legacy counters that I was discussing with my dad, and we've built up that position for the past 2 to 3 decades. Okay, so sometimes the reason I do these shallow dives is to actually understand a little bit more about my own investments and whether I need to clean up my portfolio, whether I need to reduce my holdings or to buy even more. Okay, all right. So rest assured that I will always make sure that I have some amount of vested interest in some of these stocks. Right, I'll be as neutral as I can. Okay, next, let's look at dividends and free cash flow. Okay, not too bad. Pays in August and December. 19 cents will be coming in August this year, which is pretty good. 8 cents came in December last year. Okay, so at the current price of 0.735, the dividend yield could be about 5.9%. All right, actually, this is the trailing dividend yield. It's not the forward dividend yield. Sorry, okay, that's a mistake. 12-month trailing dividend yield is about 5.9%. Okay, I did a check on the free cash flow of 2024. Okay, I think my face is covering the cash flow from operating expenses. I assure you that if you take the cash flow from operating activities, you minus off the capex, it is indeed higher than the total dividends paid in 2024. Okay, so this is definitely a sustainable yield play. All right, it is sustainable. Okay, and let's look at historical returns. Valuetronics, it's very Hong Kong, right? It's denominated in Hong Kong dollars, and these numbers strike me as very Hong Kong. Hong Kong is the place where you have these stock market movies, uh, drama serial, sometimes involving Adam Cheng, and when Adam Cheng stars in a drama serial, the stock market tumbles, right? So this is a very Hong Kong stock. Why? Because the returns are very high, 38% for the past 10 years. But it comes with a very high standard deviation of 37%. So it's risky and the returns are high. Okay. And I think what investors would love about Valuetronics is that it has a very, very high annual skew. In other words, uh, when the stock begins to moon, it's very sudden and it's like buying a lottery ticket, right? And it pays for itself. But when it declines, it might decline very gently, all right? So over time, uh, people love these stocks that behave a little bit like crypto, right? Where you get these sudden increases in value, okay? And a very wonderful Sharpe ratio of 1, which is very, very sexy, very attractive, okay? But the problem is your maximum drawdown is 46%, which means that if you time your bucket wrongly, when you buy after it moons, you can lose 46% of your capital if you really don't time it correctly. So you need a lot of holding power to benefit from something like Valuetronics. And then I did, right? I've owned it for over 10 years. Okay. Now, correlation against the SCI is fairly low at 0.32. So you can expect this to be a very good diversifier from the typical REITs and banks kind of portfolio that the viewer of this channel would normally invest in. Okay. All right. So what are analysts saying about the stock? They are cautiously optimistic, and they have a target price between 78 cents to 82 cents. So there is some upside. All right, there is some upside in target price. I've done a SWOT analysis using artificial intelligence, and it says that the strength is that it's cheap, it's got high sustainable dividends, right, which is what my constituency is looking for. The weakness is that there is lower revenue growth compared to its peers. So it's not growing as quickly as other people, right? But it's sort of like a mature company, that's giving out money to shareholders, something which I love. Okay. There are some opportunities expanding into Vietnam and hopefully expanding into the electronic vehicles and the Internet of Things segment. So there is some upside, but expect this to be at the periphery. All right. It's not going to be a majority of where your revenue is going to come from. Okay, and the usual threats include supply chain issues that you have and geopolitics. Okay, so that's how you really think about Valuetronics. Okay, so what you need to do before you pull the trigger on the stock, all right, roughly how do you go about doing your due diligence? Okay, first, I think you need to dive deeper into the industrial and commercial electronics segment and learn a little bit about lighting systems and automotive electronics. Okay, what kind of components does Valuetronics build? Go into the annual report to actually get a feel of how they look like. Okay, you might also need to have a conviction about electronic vehicles and decide whether this is going to be a growth market for Valuetronics, and the question sort of needs to be answered as well. And as Valuetronics is a manufacturer, you have to be fine-tuned to a little bit of geopolitics. All right, it can be affected by any changes in the Trump tariffs with China and geopolitics in general. Okay, I mean, good news is if Valuetronics were to dive deeper into places like Vietnam, and maybe in the future, I'm not saying that it will happen. Maybe if they say that okay, they are going to open a plant in Penang, for example, this is all good news because you want to see your manufacturers from Hong Kong and China diversify their operations into Southeast Asia, right? So that they're not hurt by the Trump tariffs so badly. Okay, now make no mistake, this is a dividend and deep value play, but it comes with wild swings, right? So you may want to consider, if you actually make a move, to do a bit of dollar cost averaging on your way in so that you can diversify your buy price based on the timing where you enter into the markets. Okay, so this is not the kind of stock like, for example, a something like Mapletree Industrial Trust, where I would actually say that it's probably better to put a lump sum in and then collect dividends every 3 months. Okay, and hope that occasionally there will be there'll be a minor crash and then you can buy some more, but otherwise, just collect your money and be happy. Okay, this you need to do dollar cost averaging, all right? Because 73.5 cents maybe next week you can get it at 69 cents, Yeah, do a little bit of that. Okay. All right, if you like my content, subscribe to my channel. You can buy me a coffee here. If you want to listen to my life story, find out how the financial independence and retire early movement works, you can sign up at this link. Alternatively, Google ERM intro and take the first link. All right, so with that, I'll see you in my next video. Thank you and goodbye.